Hi, our company's name is FlyOptics, and this is our capstone presentation. So a brief review is over our company is FlyOptic has competed in the market with high competition, where all competitors were selling the same brand of drone and AC cameras. With hard work and strategy implement, in, into, I'm sorry. Hey, Ashley, can you take over for this for me for 1 second? I'm a little nervous.
Yeah, of course.
Sorry.
All right, so just to restart this, the brief review, the FlyOptic has completed in the market with high competition where all the competitors were selling the same brand of product, which is the UAV drone and the AC camera. With hard work and strategic implement, of new operating locations and increased advertisement budgets, we continually met and succeeded our investors' expectations in critical measures like return on equity and earnings per share. We expanded our revenues each year with a significant percentage rate by making correct decisions and successfully predicting the future market. This section of the report will discuss our company's performance using 6 trends of the simulation. Right. Sorry.
No, you go ahead.
All right. The annual total revenue. In year 10, we had a small drop in the total revenues, but you can see in year 11 to 12, we had a decent sized jump, and we stayed steady in those 2 years. From year 11 to 12 to 13 to 15, our total revenues are seen trending upwards at a all-time high for our company. And you can see that through the steady kind of plateaus between those years. Our revenues consistently grew each decision year as well. The total revenue in year 15, we had a total of $1,159,306. All right, earnings per share. Our earnings per share started off trending downward in the beginning of year 6, which you can see from year 5 to year 6, it went down, but later increased during the years 7 to 9. But in year 10 to 11, we had a big dip as well. Reason being is because we tried a new approach, but we've seen that that was not working. But as you can see, during years 12 to 15, we continually increased our earnings per share. And in year 14, we had the best year so far. The return on equity. Our return on equity had gone above the 20% mark, which was set to be a great year for us in year 9. From year 10 to 12, we had an unnormal increase situation coming out of year 9, which you can see that right after year 9, we kind of have a dip, and it was just a little abnormal for our company. Coming out of year 12, we started to see a trend upwards between 13 to 14, but in year 15, we did have a slight decrease. Right, credit rating. Looking at our credit rating, we maintained a credit rating that was above our investors' expectation for each decision year. And then you can see in year 14 to 15, we noticed that we had an increase, which we believe that is from our dividends paid out. All right. The stock price. The stock price representing our company's market value has fluctuated due to the intense competition in the market. Still, we were able to create strategies to sell the value of our company in the market. Therefore, it was imperative to decide where to invest because we had limited capital. There was a slight decrease in years 5 to 6, which you can see the first line there was a small decrease. But following that period, we gradually increased the image rating of our business. It was going from $6.12 to $77.57. That was from year 6 to year 9. Because of the high competition in the market, we did have more sellers than buyers in some regions. The price did decrease from year 9 to year 12, which you can see it was a big jump from year 9 to year 10, and then from year 10 to 12, it was kind of more of a steady decrease. From year 12 to year 14, however, our stock price climbed from $30.99 to $101 to 63 cents, while it dropped slightly by $82.94 in year 15, which you can see from the decrease from year 14 to 15 there. So hold on one moment for me.
I could take over from right here if you want. Image rating. In the beginning, we was unsuccessful in starting off trying to manage our investors' expectations. But in the next couple of years, after year 8, we were able to exceed our investors' expectations. In the final 2 years, it shows a trend where our image rating dropped, but it didn't drop below 80, which was a great thing. And years 9 through 11 were the best years as far as the image rating goes. This just means that we had to take some minor adjustments to get our image rating back to the high 80s. Our strategic vision. Our vision for the company was to produce a cost-efficient AC camera and a UAV drone that would be affordable in every region that we were selling our product in. Also, our vision was to keep our product at a fair price, but also keeping the prices in a competitive market, because we were going against we were going against competitors. Also, we wanted to be able to beat other competitors' pricing on the cost of production and in sales. Moving forward, we are strongly watching our production and exchange rates for all 4 regions that we have expanded to, and we're highly confident that we can improve our EPS and the return on equity while being able to provide affordable products, but at the same time, we want to make a decent sized profit. Our performance targets forecast. So in year 16, our earnings per share was at $16.50, while our return on equity was 55%, which increased our stock price to $350. And then it left our credit rating for year 16 at an A+, which gave us it gave us an image rating of 85. Moving towards the following year 17, if we was able to continue, we predicted our earnings per share will be at $18.50. Our return on equity would increase 5%, which would give us 60% on our return on equity at average. Our stock price had went up $50, which was a total of $400 per stock price, and it gave us a credit rating still at an A+ and an image rating of 87. Our competitive strategy with AC cameras, our company adopted similar strategies for almost all regions with only some different discounts and advertising budgets. We offered a good deal and a significant amount of advertising budgets in regions that offered benefits like North America, Europe, Africa, which was 9,000 for advertising budget and a 10% discount, and an $8,000 advertising budget with a 15% discount for Latin America and a 5% discount for Asian Pacific markets. While the retail price of our AC cameras was above the industry average, we overcame the price disadvantage because of our competitive edge over rival companies. We had a performance quality advantage over our competitors with an above industry average PQR rating of 7.9. That led to a higher volume of sales and large market shares because a more significant percentage of buyers in North America and Europe, Africa, and Latin America purchased the brand with a higher PQR rating. Our team also spent a lot of money on research, on search engine advertising, and website enhancements, which helped us attract shopper traffic, generated more considerable unit sales volumes, and it gained significant market share. Give me 1 second. I have to move the bar. Our competitive strategy in AC camera. In the graph shown, overall, in these 4 regions, we differentiated our camera from rival brands based on product performance and quality. We had a higher market price for our cameras than the industry average. However, we still generated a high demand for our product as our PQR rating was significantly higher than our competitors. The strategies we used made us top our competitors in the market, as we can see from our graphs. Our competitive strategy for the UAV drones, the general strategy that we followed was to provide an average quality product at a modest price. We wanted to build the product reputation for the UAV drones, a good product for a reasonable price. But to ensure we continue following this approach, we took further precautions, including investments for improvement, worker incentives, and training to ensure our product is continuously improving. We utilized the 2 mentioned strategies by giving customers higher perceived value and authentic, better quality for the money that they spent. We offered a higher discount rate of 12% for North America in year 15 compared to our competitors and industry average to our online retailers. Danny, would you like to take over?
Yeah. So I can take over competitive strategy in drones. Our increased spending on marketing from website display to search engine advertising has contributed to our high brand reputation of 81 score, equal to the industry average. That has allowed us to differentiate our brand. Given the high reputation, we offered 360 days of a warranty period across all the region and the highest peak rating of 7.5 on the market compared to other competitors and the average industry rating of 7.2. We have differentiated and positioned ourselves at a uniquely competitive spot where we have convinced our customer of the better perceived value, quality, design, and the features that came with purchasing our drones. That has been reflected in our financial performance that indicate the success of our strategy. Production strategy. At FlyOptic, our company, we used various production strategies, but we finally agreed to a process that we believe that will work. Overtime can be seen throughout the year 6 to 10 in production, mainly for drone. That was the biggest generator of our profit. There was times when overtime could be seen either in AC camera and the drone drove the increased production like in year 10. In year 11 to 15, we avoid overtime and complete production within the time frame. For the assembly facility during years 11, we increased and added 125 new workstations for AC camera and 150 new workstations for drone. Following that year, we decided to stop the addition of workstations and use the beginning gross investment each year for both products into the end of year 15. We offered more favorable compensation package to workers in the UAV drone workforce. They needed more skills and paid attention to details than the AC camera workforce. We also provided increases in base wage, incentive bonuses, attendance bonuses, friend benefit package to keep the labor workers satisfied and motivated for the success of our company. We improved the training by a significant amount in the drone sector than the action camera, since we were producing more drones. Therefore, those are the aspects that lead us to develop our production strategy to compete in the market. Financial strategy. In year 8, we repurchased a portion of stocks as we believed it was necessary at that stage. We did not issue any stock throughout the operation and closely held our stocks. After year 10, we were able to pay shareholders dividend as we were at positive net cash balance. From year 10 to the end of year 15, we paid out a consistent and repetitive dividend. Year 10 to 11, we paid 5,525, and the year 12 to 15, we paid 7,735 dividend for our shareholder. That would have kept the shareholders satisfied as they obtain the benefit of investing in the company. Based on the earning per share per year, we have exceeded the investor expectations each time. Therefore, if we were to pay out dividend for the next 2 years, we can continue to pay out the same amount or increase our payment amount as we are capable of the increase due to the increase in net cash that we obtain each year. Our debt to equity ratio is excellent as debt decreased as the equity increased each year. In the end of final debt to equity ratio was 22.5%, which is perfect because we don't process an amount of debt. We didn't take any loan throughout the operation of our company, and we worked with a sufficient cash balance which was able to cover any expenses that had been incurred. We maintained a good credit rating as shown in the image throughout most games. We avoid the bank's help and had outstanding ratio such as current and interest coverage, which contribute to achieving an A+ credit rating. Therefore, those were the most effective strategy our company implemented and used throughout the simulation. Strongest, closest competitor. The most direct competitor in the AC camera are company D and C. In year 11 to 15, those companies have gained considerable market share in Europe, Africa, and Latin America, North America, and Asia Pacific for Company C, compared to our other competitor. In year 15, for North America, companies C and D achieved the highest demand for AC camera unit. Like for company C, they achieved 448.4, and the company D 464.9, and sold all AC camera units in North America during this year. Company C also had the highest brand reputation in all regions with 93 in year 15. We have company C and E as direct competitor in the UAV drone segment. In year 14, our company led the competition with the most sale of drones in Europe, Africa. We sold 88.7 units within a total demand of 86.8 in year 15. Company C had the highest score in brand reputation in Latin America. Also, Company C sold a significant number on units, like 109.9, then our company in the second with 99.4 units sold. Company E was the first in the Europe Africa region to sell 92.9 units, then other companies also led the industry with the most market share among all companies with 20.1% in the year 15. Company B can also be seen as a competitor. They came after our company in the market share with a rate of 19.8% against 20% of our company F, the FlyOptic. So the competition in the drone industry was intense. Many companies made great effort, including our company, to conquer the market. Actions to outcompete. We plan to outcompete our strongest, closest competitor by staying accurate to our previous strategy for both S camera and the drone segments. A strategy like global best cost leadership and global differentiation strategies will be implemented to gain the market. Based on the strategy, we aim to keep production costs to minimum by minimizing our value chain activity in the workforce and the research and development expenditure. We also plan to maintain our high product quality while still staying price competitive with the other companies. In terms of the UAV drone, we plan to continue our same strategy to outcompete our competitor, mainly company C and E, with a little bit of focusing on market niche strategies. The global base cost approach focuses on the idea of giving more value for our customers' money. By utilizing this strategy, we can provide our customers with more value for the money they spend. We will also continue to invest in our marketing spending as it generates great results for us by generating a good brand reputation score. Being one of the highest in the interest in brand reputation, we will continue this strategy further to stay on top of our company or of our competition. So someone can go for the last slides.
Yeah. For the lessons we learned during the whole simulation, we learned that hard work will always outweigh talent. As co-managers, we realized that there are specific strategies that managers should take to help them become financially and competitively successful against the competitors. In any scenario, the assets must be greater than the liability and revenue must be greater than the expenses. That will allow the company to earn profits and continue expanding and growing the company. And implementing the same prices, discounts, and advertising budgets for all regions does not guarantee the desired market share and revenue. I'm going to go back to that one. That last one, I believe that is a great lesson that we learned because we tried that strategy within the middle of those years where we seen a huge drop in sales and things like that. We were trying to do the same prices and discounts for each region across the board. So we noticed that wasn't really a good strategy to try to use moving forward. It is wise to adjust and market your items according to what works best for each region, as a copy and paste method is not streamlined or efficient. As co-managers, we need to focus on long-term gains rather than short-term profits. We notice that if managers are too focused on earnings from year to year, it can result in lower numbers in the long term. As co-managers, we should focus on long-term revenue and market shares, which we could then form into high profit margins with our increased market share, which will lead to more financial success for the company. It is beneficial to reevaluate numbers every year and decide what the next course of action would be. Every week as co-managers, we need to discuss how to increase profits, revenue, market shares, and credit rating. Also, with high competition, we need to improve our public perception before our company was out-competed constantly. In addition, we learned that the PQR rating and price of our products had a significant influence on customers' demand. So we should always plan how to provide a quality product to the customers at a reasonable price considering the competition. Finally, our company learned that the worker satisfaction was vital to productivity and efficiency. We believe that this simulation has taught us a lot about the real world aspects of the business world and how we can implement it into the workforce. Therefore, we believe that this was a delightful experience that opened our eyes to the business world. That is all.